Do I like Microsoft's business? Heck yeah. I use many of its products and services. And the company, it just continues to add a lot of value to society on many fronts. As a result, it continues to grow its sales. As you can see, its sales have climbed at a pretty impressive clip, at least for the size of a company that it is. This is really impressive to see. But as an investor, I have to be really conscious of the value I get relative to the share price. In words of Warren Buffett, whether stocks or stocks, I like buying quality merchandise when it is marked down. When it comes to stocks, it's really pretty easy to see their value, but multinational corporations, on the other hand, it's not so easy to determine what they're worth. That's why we see a lot of really short-term volatility in the stock market. Nonetheless, there are some pretty simple metrics we can use to get a better idea of Microsoft's current valuation. I'm going to show you why I won't personally buy Microsoft stock today. Also, the company recently announced a $60 billion stock buyback. It's bought back plenty of shares over the years, but anywhere near its current valuation, that's probably a bad move for new investors and existing. Now, before we dive in, I'd really appreciate it if you just tap that like button down below as well as subscribe. That really helps support my channel. And if you have any comments that come up or questions, please drop them down below. I'm still able to read everyone. In the past, Microsoft has shown some outstanding returns. Investors should be pretty happy, although its run-up in price is far outpacing its fundamental growth. In the past 10 years, investors are up well over 1,000%, and the bulk of that has come in the past 5 years. The company is now worth over $2 trillion. It's really not far from Apple's market cap. Although this size alone, it really doesn't tell us much. So let's go ahead and compare Microsoft's price relative to what the company earns. Microsoft's price to earnings, the famous PE ratio, it's experienced close to a 400% increase in the past 10 years. It's gone from below 10 to close to about 40 today. New investors are willing to pay about 4 times more for $1 of Microsoft's earnings than they did in the past. Now, this valuation, of course, could make sense if earnings growth, it picks up even more in the next few years or in the future, but that's pretty unlikely to increase at a much higher rate. So the PE ratio is a favorite among many investors, but to be honest, I'm not really a big fan. Price is easy to kind of determine and see over time. It remains fairly constant. I mean, the price changes, but how you determine it remains pretty constant. So it's the earnings side of the equation that's easily manipulated. It's further down on the income statement. This makes it less reliable over time. For a less manipulated valuation metric, let's go ahead and swap out earnings for top-line sales or revenue. Here's Microsoft's price to sales, the PS ratio, over the past 10 years. You can see a similar trend and valuation expansion. Investors buying Microsoft stock today are willing to pay more than 300% more for every $1 in sales per share. This is a steep valuation. Over the past few years, there's been a lot of money sloshing around the markets. It's helped keep interest rates low and push up valuations across the board, and I doubt this is a new normal. The Fed and other more recent stimulus, it's helped kick the can down the road. But my money is on mean reversion. Just as we've seen time and time again for more than a century, prices will likely drop along with these valuations. All right, so Microsoft, it's a mature business that's generated more cash than it can really reasonably invest. As a result, it's been returning some of its earnings to investors via dividends and buybacks. And I'm a big fan of both. Dividends put money in investors' hands. They can then decide where to put that money to work next. Now, this does push some taxes forward, which isn't always ideal, but it can still make sense for stable businesses with big cash flows. Buybacks, on the other hand, aren't always as straightforward. They only make sense when the company's stock is undervalued. It's the adage, buy low, sell high. As you've seen, Microsoft is trading at a premium. This is true based on many other valuation metrics as well. With that said, I should point out that the new share repurchase program, it has no expiration date. So maybe they'll want to buy back shares when there's more of a pullback. Although the timing is tough to do well. And with a lot of companies, some internal incentives often lead to share buybacks at not ideal time for average investors. There's also the opportunity cost of keeping a boatload of cash on the books instead. But as mentioned, if the main goal is to reduce the low earning cash position, increasing dividends would likely be a better route, at least around its current valuation. Although the dividend hike consistency and sustainability is another important kind of consideration to factor in. So overall, Microsoft is a solid company, but valuation-wise, I'm keeping my distance as an investor. Instead, I think there are better risk to reward opportunities. Alibaba, for example, is the newest addition to my portfolio. It's also a tech giant, and it's down from where I bought it at. It's been a little painful to see in my portfolio, but I still like its potential over the next 10 plus years. There's a high probability of it being much higher than where it is today. So you can check out why I bought Alibaba stock in this video, and I've linked to it down in the description below as well. Also, if you've enjoyed this video or found something useful, I'd really appreciate it if you just tap that like button down below, as well as subscribe for more research. And feel free to drop any comments down below. I try to read everyone.